Hey guys, welcome back to the Value Investor Show. Today I want to talk about Nebius, and many people have been arguing that Nebius is the next big thing, the next Palantir. And today I want to unravel everything. I want to reveal the truth behind his 40% dive over the last month and everything you need to know about Nebius. So for today's video, I want to go through the stock, the reasons behind this recent drop, the company Q3 earnings, the fundamentals, the expected financials for the next few years, my thesis, and whether this is an investment or simply too expensive. As always, thank you so much for watching my videos. It genuinely goes a very long way. This is a brand new stock that I'm covering today, one that I have been studying over the weekend, so bear with me while I'm still trying to navigate this company. If you're new here, I would love if you could subscribe and join my journey. And if you want to show some love or give back, you can become a subscribed member. For members, I release videos weeks in advance, especially the more specific videos where I show the stock that I personally am buying. For example, I released a video about a new company in my portfolio. Members have access already, but for everyone else it will release next week. So if you would like to support the channel, it really would mean the world to me. I'm trying to get to 4,000 subscribers by the end of the year, so if you're new here, please subscribe. Now, Nebius has had a very bad run over the past month. It's down 35% in a month and roughly 36% from all-time highs, but in the grand scheme of things, this was a $20 stock in April, so it had a massive year. Even though the last month has been ugly, the company overall had a fantastic run, with many investors, especially retail investors, making a lot of money on this company. For me, the funniest part is really just stock psychology. The same thing happened with Google, Meta, AMD, and United Health. When a stock is at an all-time high, people say, I wish I had loaded up earlier, but the moment the same stock drops back down to those exact earlier price levels, nobody buys. And it's the same thing with Nebius. Everyone wanted to buy this company at $86. Now no one wants to buy it because it's a falling knife. Now yes, the company has had a fantastic run over the last year. It's up 370%, almost 5x in market cap, but the real question is the valuation deserved? And that's where I want to focus today. Why the company is or is not valued correctly. So for those that don't know, Nebius, known as Nebius, is the successor of Yandex NV, the Dutch parent company of the Russian internet giant Yandex. Yandex started as a search engine, often called the Google of Russia. Founded in 1997, it expanded into search, cloud storage, machine learning, autonomous driving, and more, very similar to what Google offers. Following the Russia invasion in Ukraine in 2022, the company faced sanctions and Nasdaq trading suspensions, forcing it to sell its Russian assets in a $5.4 billion deal. The remaining non-Russian business focused on AI and cloud infrastructure was rebranded as Nebius. Nebius moved its operation outside of Russia, with data centers in Finland and engineering teams relocating to the US. But here's the most important part. All the talent, the CEO, the founder, they stayed the same. So this is still a company with enormous expertise, mature infrastructure, and people who know how to execute. This is not a startup, it's a fully formed tech company with deep talent and world-class engineering. In the last few weeks, there have been a lot of 13F filings showing something significant. Institutions have been buying huge amount of Nebius shares. In Q3, there were a net buying of 18.5 million shares. So it was 24 million shares bought versus 5.4 million shares sold. Top quant funds have been buying heavily alongside big banks like Citi, like JP Morgan, as well as Ray Dalio's funds, Soro Capital Management, and even BlackRock. But remember, all this has been before the big sell-off. I expect the next set of 13F filings to show something very different, because many of those same funds likely sold during the Q4 drop. Then we have a Goldman Sachs research report which was released 3 days ago, a very bullish report covering the company's main enablers, financial forecasts, and price targets. Let me break down the 4 key takeaways. Number 1, massive AI demand plus supply constraints equals to pricing power. Nebius highlighted extremely strong Q3 demand. Their pipeline grew 70% quarter on quarter, but they only converted a fraction of deals due to capacity constraints. They simply don't have enough infrastructure to meet demand. They're adding significant new capacity in Q4. They're also seeing strong demand for Blackwells, with customers securing long-term contracts. Nebius remains one of the few companies who can actually deliver this. The second one is that they have upgraded their 2026 power roadmap, which points to accelerating infra deployment. Nebius introduced a connected power target of almost 1 gigabyte by the end of 2026, meaning fully provisioned power ready for activation. More power equals more AI infrastructure equals more revenue. They also increased their contracted power guidance to 2.5 kilowatts, implying 25 billion in revenues, above Goldman Sachs' own prior base and bull case scenarios of 10 and 20 billion respectively. The third one is the hyperscaler traction. There is continued strong traction from large-scale hyperscalers contracts, which further validates Nebius' product offering with an ARR target that suggests growth. Nebius signed a 17 to 19 deal with Microsoft in September, and then a 3 billion 5-year term with Meta. They expect 7 to 9 billion ARR by the end of 2026, and more than half is already booked. This is a big deal as the company is raising its mid-term revenue guidance based on already closed hyperscale partnerships. The fourth one is the UK and Israel remaining strong strategic growth regions due to their demand and due to government subsidies. The UK and Israel remain strategic as Nebius is securing several large sites across Europe and the US, including plans to serve Microsoft in New Jersey data centers. Goldman Sachs updated their financials. They have lowered their FY25 and FY26 guidance to reflect the updated view based on the Microsoft and Meta deal. However, they have raised their FY27 and 30 top line growth, as they also raised their price target on Nebius from $137 to $155 and kept the buy rating. They now expect $7.6 billion in revenue by 2027. They also expect 10 billion in revenue by 2030 versus the old 8.97 billion they expected with their previous forecasts. They're also expecting 25% margins, meaning 2.6 billion in earnings before interest and tax. Now, according to the CEO, 2025 was a building year. They build infrastructure and frameworks for future growth. They're sold out of capacity in 2026, meaning demand is far exceeding supply. Revenue grew by an impressive 355% year on year. Quarter on quarter, the revenue grew 40%. They have also raised 4.3 billion in September via convertible notes and an equity offering, and they're growing their contracted power and connected power to meet the demand that they have. As the company sold out all of its available capacity, is continuing a trend during the year showing strong demand and effectiveness of their business strategy. Some of the things that were highlighted in the Q3 call were, as we said, the contracts that they have agreed with Microsoft, valued at 17 to 19 billion, as well as their infrastructure deal with Meta, valued around 3 billion over 5 years. The company is aggressively increasing data center capacity to support these large deals and core customers like startups and enterprises. In September, they also raised the 4.3 billion, as we have already said. The new Nebius AI Cloud Ether platform and Nebius Token Factory inference platform were released to target enterprise customers with trusted, scalable AI workloads. Nebius is building a large software and service pipeline to create strong competitive moats, and 2025 was seen as a foundational year preparing for rapid growth and positioning Nebius as a top global AI cloud business by 2026, with 2026 being the beginning of a longer growth trajectory. Uber became a strategic investor in Nebius autonomous driving division, and financing plans for 2026 and 2027 include a corporate debt, asset-backed financing, and equity with the new ATM equity program for up to 25 million shares to maintain capital flexibility with managing dilution. I'm going to talk about this in just a second, but Nebius also expects an annual run rate revenue of 7 billion to 9 billion by the end of 2026, strongly committed to aggressive business growth. The CEO acknowledges that 2025 was as a build year, laying infrastructure and framework for future rapid growth. So, regardless of the results, Nebius continued to fall for a few reasons. The first one was that the sentiment was pressured due to the announcement, as I just said, from the market equity program for up to 25 million shares, raising investor concerns about potential dilution. Apart from the dilution concerns, there are general fears in the market around AI capex. Investors worry that some deals might not materialize, that spending is made up, and in a nutshell, the dilution plus the AI infrastructure bubble risk created a massive downward trend for a few days for Nebius, which caused the stock to dive down every single day. Some other recent developments include that Nebius Group will be added to the MSCI World Index as of 25th of November. The inclusion marks a milestone for the AI infrastructure provider, potentially expanding institutional ownership. Also, Northern Capital lowered this price target from 211 to 206 while maintaining an outperform rating, and trader sentiment surges on community platforms for the stock, especially in Reddit and X. For me, the largest risks to Nebius are the execution issues with the data center expansion, the sales pipeline following said build-out, and methods of financing the growth that could be shareholder dilutive. The second one is the macro risks are the supply-demand dynamics for AI compute and utilization of data center assets, the overall financing conditions of the market for raising capital, and technological changes that will reduce the value of a GPU-centric industry. So it's not just the fact that there could be execution issues, but also the fact that a lot of companies are committing to these investments, but it doesn't mean that they will go through. There could be a macro downtrend, which could mean that companies will spend less and less into AI, into infrastructure. And especially if we see that AI is not actually bringing in return of investment, I think that could be catastrophic, not for just Nebius, but for a lot of companies in the AI ecosystem. In terms of if I'm buying or not, I think the company is quite complex. There are many deals and expected revenue streams in the future with many bits and pieces scattered. It's definitely a very promising company, is one with great talent. I truly think that the CEO is great. The team that they have is fantastic. They're building for the right thing, but I need to further study the company and examine whether the expectation will actually happen. You know, the deals that they have agreed, how solid they are, how likely are they to materialize, and whether there is a clear path to profitability. In terms of valuation, I do think that the traditional metrics, the traditional way of valuing this company will not work, simply because this company is primarily driven by the deals that it has agreed. And also there are no historical precedent, given that this is a new spin-off from the existing Yandex company, as we said. So I cannot value the company by the traditional way that I value companies. However, truth be told, if the story checks out, if this company is set to deliver what they are saying they will deliver, I think this could be a massive opportunity for massive returns. But even at the current price, I see it as priced in for perfection. I think that the current price would only make sense for me if all the deals were to happen, if there is more bullish sentiment. But at the end of the day, we don't really know if these deals are to materialize. It's a very risky investment which needs further studying, but the current case makes the thesis case harder as is. But I will continue looking at Nebius. If you guys want me to cover it in the future as well, let me know in the comment section below. Thank you so much for watching as always, and I'll see you guys in the next one.